Silver wasn't supposed to behave like this. Not in a year when most analysts were focused on tech stocks, inflation forecasts, and central bank policy. Yet here we are, watching a metal that usually moves like a quiet shadow suddenly make sharp, attention-grabbing jumps. Prices climbing, premiums widening, inventories tightening, and a market that feels like it's shifting under the surface. But the most interesting part isn't the price, it's the behavior behind the price. Because markets rarely shout when something important is happening. They whisper. And right now, silver is whispering loudly. For years, the narrative around silver has been simple. It's industrial. It's boring. It's unpredictable. And on the surface, that seemed true. Silver didn't move like gold. It didn't act like copper. It lived somewhere between them, never quite fitting the story people wanted to tell. But while the public dismissed silver as a side note, some of the largest institutional players in global finance quietly accumulated it. Not trade it. Hold it. Over years, over cycles, through corrections, through periods of low excitement, and whenever the biggest institutions in the world behave in a way that contradicts the public narrative. That's not noise, that's signal. To understand that signal, you have to understand the architecture of this market. Silver isn't just a commodity, it's a dual-layer system, part physical, part financial, and those two layers don't always align. The physical side is the real metal, the bars and vaults, the coins and safes, the thousands of tons used every year for manufacturing. This world moves slowly. It's governed by geology, cost, energy, and time. You can't rush a mine. You can't speed up ore grades. You can't cheat physics. Then there's the financial side. Futures, derivatives, options, synthetic exposure, and leveraged positions. This side can expand infinitely because it isn't limited by physical metal. It's limited only by confidence. Most of the time, the two sides coexist peacefully. Futures provide liquidity and smooth volatility. Arbitrage opportunities keep prices aligned, and the physical market hums quietly in the background. But this balance is fragile. And when stress builds, the financial layer begins drifting away from the physical layer. That's what we're seeing today. Across multiple regions, industrial demand is rising faster than expected. Solar installations are accelerating globally, and each panel requires silver for conductivity. Electric vehicles continue scaling, and nearly every high-performance battery or circuitry system relies on silver in one form or another. Electronics manufacturing, from smartphones to servers, consumes silver at a pace that compounds each year. Even medical technology, from X-ray equipment to antimicrobial coatings, depends on silver. This demand doesn't care about investor sentiment. It's steady, it's structural, and it's growing. Meanwhile, mining supply isn't keeping up. Some regions are declining, others are flat. Few major discoveries have been made in the last decade, and the cost of extraction continues to increase as deeper, lower-grade ore becomes the norm. So you have a metal with rising industrial demand, stagnant supply, and a financial system built on promises that outnumber the available metal by a wide margin. Normally, this imbalance stays hidden, but over the past several weeks, it's been harder to ignore. Dealers reported tightening inventories. Premiums rose even when spot prices didn't. Borrowing rates for silver, essentially the interest cost for temporary access to metal, spiked. Some vault categories shifted from deliverable to non-deliverable, and futures markets reacted to small pockets of thin liquidity with outsized volatility. None of these events are dramatic on their own, but together they paint a picture of a system under quiet stress, a system reassessing the relationship between paper and metal. And this brings us back to the accumulation story. For over a decade, institutions with deep balance sheets moved large amounts of physical silver into their vaults, not because they wanted to manipulate the market — that narrative oversimplifies reality — but because they understood something fundamental. Leverage is abundant. Metal is not. Physical silver is slow, heavy, expensive to refine, and difficult to move in size. But once you have it, you control something that the financial market can't replicate with keystrokes. That's why accumulation matters. It's not speculation, it's architecture. Historical patterns help explain this. Silver isn't unique. Many commodities have experienced moments where the financial layer grew so large that it masked underlying scarcity, until the scarcity could no longer be ignored. Palladium saw this. Nickel saw this. Certain grain markets experienced it a century ago. Each time, the financial layer behaved normally, right up until it didn't. And the transition from everything is fine to the structure is shifting always begins with the same subtle indicators: inventory drawdowns, rising lease rates, widening spreads, and growing difference between paper price and real-world availability. Silver is now showing those indicators. Understanding this moment doesn't require predictions. It requires recognizing incentives. Every participant in this market, miners, refiners, manufacturers, banks, traders, and investors, acts based on the incentives in front of them. Miners extract at the pace geology allows. Manufacturers buy as much as they need, regardless of price. Traders use leverage to control exposure. Institutions accumulate when they believe future availability may tighten. And retail investors follow the story after the structure is already shifting. Right now, the incentives for institutions increasingly favor physical ownership over purely synthetic exposure. That doesn't mean a squeeze is imminent. It doesn't mean prices skyrocket. It simply means the architecture of the market is recalibrating. And recalibration shows up in behavior long before it shows up in charts. To understand why this matters, think about what silver represents in the broader global economy. It isn't just a metal, it's a foundation, a quiet backbone behind modern electrification and communication. If copper is the circulatory system of industry, silver is the electrical synapse, the part that carries the signal, which means even small shifts in availability ripple outward. A delay in silver delivery doesn't just affect coin buyers. It affects solar installations, battery production, server manufacturing. Every part of the technology supply chain feels it. And when essential industries start competing with financial markets for the same finite supply, price becomes only one way the system adjusts. Behavior becomes the more interesting signal. Manufacturers may secure contracts earlier than usual. Institutions may reduce the amount of metal they lend. Vaults may shift metal from deliverable to non-deliverable status. And paper markets may move faster than usual during thin sessions. These aren't predictions. These are historical patterns. The same kind of patterns we've seen whenever the financial representation of a commodity grows out of sync with the physical reality beneath it. So here's the real takeaway. Silver isn't breaking, it isn't exploding, it isn't collapsing, and it's revealing the true state of a system that has relied for decades on the assumption that paper claims will always match physical availability, and revealing that in a world of rising industrial demand, that assumption becomes harder to maintain. This moment isn't about price targets or future forecasts. It's about structure. It's about understanding the architecture of a market that is shaped by geology, energy, technology, and leverage, all at once. So the question I'm watching isn't, what will silver do next? It's this: how does a system behave when its financial layer grows faster than the metal that underpins it? Because that question has shaped commodity markets for over a century. And silver is now entering its own version of that story. This is Money Margins. Thanks for watching, and I'll see you next time.